Welcome to our podcast, Don't Chew With Your Mouth Open. Thank you for joining us. For those who are subscribers, thank you for liking and sharing our content. For those who are watching for the first time, please subscribe, and I hope we can enjoy watching and sharing our views together. Welcome to our episode of our podcast, Don't Chew With Your Mouth Open, where we'll discuss business, economics, finance, investments, and wealth creation for the global south. We got a tweet that was sent to us from one of our listeners, and we're going to share it today and discuss it. This tweet comes from a lady called Musanati, and she says, contract phones are 48 months. Cars can be paid over 84 months. You can walk into a shop, take goods now, and pay for them later with PayFlex. You can make an instant loan up to 10,000 Rand on your app. Soon you will be able to ask for a salary advance with Pay Me Now. Instant gratification and debt will be the end of the middle class, because they tell us we qualify, but do not overstretch the fact that qualifying doesn't necessarily mean you can afford. Okay. So this tweet suggests that the middle class is hurt by overextension of credit, continuing being given the credit facilities that enable you to go out and access whatever it is you want to access. However, the ability to access credit doesn't necessarily mean you can afford that credit. Money paid out today in advance does not mean you can afford to pay that money back. The key element here is managing your ability to afford. All right. Okay. So human beings, as people in general, will always prioritize gratification upfront before delayed gratification. And this process in psychology is called temporal discounting. It's a part of our human condition where we always seek the pleasure upfront rather than actually holding back so we can have a long, sustainable future. The ease of access to credit that we currently have creates an environment in which you can begin to have instant gratification today. You can afford to do something today. She raises a key element, especially around the pre-funding or the advance of your salary, the ease at which you can open your app on your phone and you're pre-approved, and you've got a large amount of money that can be made readily available to you. Credit access, especially if you have a steady flow of income, is very high. So we have to ask ourselves, how do we manage this? The more we need to borrow, the more we are selling our future income and spending it presently. The structure of your car payment, the structure of your credit for clothes and goods, the structure of your loan amount all lean into this. Now, it's important to have a great credit rating. It's important to have a good credit history. However, the fact that it's being provided or given to you does not mean you can afford it. The general rule of thumb is you must only take or borrow 50% of what is being made afforded to you. So if 100,000 is being made afforded to you, you should only access 50%. We had an experience like that personally when we were buying our home. The bank gave us a pre-approval of a certain number. We halved that number and we looked for homes within that scope. Because we have that number, we're able to get a good home at a good price with a sizable deposit. And those sort of things reduced our debt burden as a family. So it's important to think through the psychology of these things. Understand, why does having money now feel so good? Why does buying that thing immediately trigger a great rush in your emotions? The Rush will be enjoyed now, but the price will be paid later. The ease of access to these credit facilities directly exposes or targets or exploits our need for that discounting, our need to please ourselves today. Those products are designed to ensure that that part of your psychology is fully explored, because the banks and the financial institutions know that the moment you spend that money, you're going to want to do more. And they will continue to provide it with revolving loans, overdrafts, credit cards. They're going to continue to allow you to have balloon payments for your automobile or discounts for your clothing cards. These things often impact us negatively in the long term because you start working to pay off debt rather to building wealth. So what are we saying? You need to assess the quality and the appropriateness of the financial products you engage with. Is it needed? Do I need it now? Am I using it for consumption or for further, more productive issues? Yes, you could borrow a certain amount of money to redo your home. You could borrow a certain amount of money maybe to pay for an unexpected expense. But when you begin to live out of your credit, it begins to create a debt trap for you. Then every rand earned, a large percentage is going back to paying for something you enjoyed months or years before. And yes, it's a pleasurable thing at this point. But over time, it's taking away from your future and inevitably taking away from even your children. So let's explore it. Debt qualification versus affordability. From the lender's perspective, they look at a debt-to-income ratio. How much can you actually afford to borrow? How much have you currently borrowed? And what is the gap between that affordability and what you have? They then look to exploit that gap and provide you with more products. From a consumer's perspective, you must look at what is the money being used for, how am I going to pay it back, and the duration of that. That debate or that struggle between qualifying for debt and affordability must consistently be managed. If you don't manage it, it will hurt you. Because the debt is available doesn't mean you can afford it. The rates of interest, the cost of default are very, very high. Okay, let's let this play now. So there's three things. The first one is budgeting. Understand where your costs lie. Understand your affordability. Understand what's actually happening. The second one is needs versus wants. Borrowing must be for productive activities only, not consumptive. Yes, scenarios can come that stretch you, but the primary need for you to borrow is for productive activities. And finally, understand the T's and C's. There's always in the small little print, T's and C's apply. Understand what it actually means. What are the terms of conditions for my borrowing? What will it look like over time? What will I have to pay back? I hope this episode has been helpful, and I hope we continue to focus primarily on affordability, not availability of debt. Understand that the more we stretch ourselves and the more we borrow, the harder it is to exit.